Peru is preparing for a massive 2026. From the heart of the Santa Rosa Valley, exporters are gearing up for a major expansion of their Mandarin exports across the entire American continent. But this isn't just about growing more fruit. In a world of surging costs and logistical uncertainty, the industry is facing a critical margin squeeze that could threaten the entire campaign. How will these producers protect their profits and outshine the competition in such a volatile market? Today we explore the high-stakes strategy behind this Peruvian citrus takeover. Let's jump in.
Okay, so let's talk about Peruvian mandarins. The industry is revving up for a massive 2026 export season, and they are aiming high. But as we're about to see, the path forward is loaded with some serious economic headwinds. We're talking pressures so strong they could put a real squeeze on even the best producers.
We're going to see how this one fruit, a mandarin from Peru, is actually at the very center of a massive global strategy. A strategy that's all about chasing ambitious growth while staring down some pretty intense economic pressure. So our story kicks off right here in the absolutely beautiful Santa Rosita Valley, which is just north of Lima, Peru. And while, yeah, it looks incredibly peaceful, for the growers here, this is basically the front line of a huge global business challenge. The question they're all asking is, how do you possibly expand and stay profitable when the world's economy is just so uncertain?
To really get what's going on, we're going to zoom into the Santa Rosa Valley, just a bit north of Lima. This beautiful spot is home to Gamma Fruit and Agro Gamarra. Now, these two companies are right on the front lines of this whole thing. What they're planning for 2026, honestly, it's a masterclass in modern agricultural strategy. And this question right here gets to the absolute heart of the matter. For exporters like them, it's not enough to just grow more fruit. Nope. The real challenge is, how do you stay profitable when it feels like the entire world is conspiring to drive up your costs, from fertilizer all the way to freight?
Okay, first things first, let's talk about the ambition here. We're not talking about small moves. Peruvian mandarin producers are gearing up for a truly massive 2026 season. And they're not just, planting a few more trees. They're aiming for a major leap in scale.
That brings us to the main theme for this whole breakdown, the balancing act. You see, success in 2026 isn't going to come from one single move. It's all about solving a really complex strategic equation, one with a ton of competing variables.
A key player at the heart of all this is a company called Gamma Fruit. Get this, from their 40-hectare base, they're targeting 170 export containers. That is a staggering amount of fruit, and they're not doing it all by themselves. They pull it off by building what they call technical alliances, which is a smart way of saying they partner up with other local producers to share knowledge, resources, and best practices. It's really a strategy of growing together.
170. That's the target. 170 containers for export in 2026. That is a huge number. But what's really fascinating here is how they're going to get there. It's not just from their own orchards. The secret sauce is these crucial technical alliances they've built with a whole network of other producers. It's how they multiply their output. Their own production, it's the foundation, about 40 hectares worth. But as you can probably guess, that alone is not going to get you to 170 containers. No way. It's that blend of what you own directly, plus these powerful partnerships, that creates the kind of scale you need to even play on the global stage.
But, hitting that kind of scale isn't just about planting more. The really smart play here is diversification. You have to. To protect yourself from all these unpredictable market shocks, you just can't, as the saying goes, put all your mandarins in one basket. So here's how they're actually doing it. For a long time, their main focus was on popular varieties like the W. Murcott. People love it because it's super sweet and it has a great shelf life. But now, they're strategically adding new volumes of Satsuma and Primosole. And the reason for this is all about timing. See, these different varieties ripen at different points in the season. That creates way more flexible trading windows and makes their entire supply chain much more resilient if prices suddenly start to swing. Pretty clever, right?
And check this out, they're not just growing more, they're growing smarter. On the left, you've got their core varieties, the ones that are their bread and butter. But look to the right. That's the strategic move for 2026, bringing in Satsuma and Primosole. By adding these, they're diversifying their harvest and selling windows. It makes their whole supply chain way more resilient and less vulnerable if the price for any single fruit takes a dip.
Okay, so you have this huge ambition, this smart strategy, but it's running head-on into a massive wall. The reality is, Peruvian exporters are facing a really serious squeeze from a tough global economic environment.
Okay, now for the other side of that equation we talked about, the friction. This is where we run into those major macroeconomic headwinds that are putting some really intense pressure on profit margins.
And this right here is the core of their problem. In the industry, they call it the margin squeeze. Just picture it. On one side, you have agricultural costs. We're talking everything it takes to grow the fruit, and those costs are skyrocketing. Then, on the other side, you've got logistics and shipping, which are getting way more expensive and totally unpredictable. The profit margin? It gets absolutely crushed right there in the middle.
You've got the soaring cost of things like fertilizer on one side and the crazy volatile cost of shipping on the other. And the exporters' profit margins? They're stuck right in the middle, getting squeezed from both directions.
And when you break it down, you can see these are huge, global pressures. I mean, fertilizer costs are surging, and that's a direct result of international fuel shocks. At the same time, shipping companies are already talking about rate hikes, and just finding available space on a container ship, that's become a massive headache all on its own.
And listen, this isn't just some abstract economic chart. This is real. Here's Christian Gamarra, the general manager of Gamma Fruit, laying it out in plain English.
The global situation, especially with fuel costs, is directly hitting us bottom line before a single Mandarin even leaves the farm.
So you might be thinking, well, why not just pass those costs on to the customer? If only it were that simple. The thing is, the global price for mandarins is surprisingly stable. It kind of acts like an anchor. The real risk is in the details. See, smaller fruit sizes have much more volatile pricing. So what does that mean? It means getting the size, the quality, and the timing exactly right is absolutely everything.
So you might be thinking, well, can't they just raise their prices to cover the costs? That's the tricky part. As this chart shows, global mandarin prices are actually pretty stable, especially compared to other fruits. And while stability is normally a great thing, in this case, it means there's just no room to absorb these massive cost increases. The market price isn't going up nearly as fast as their costs are.
Okay, so with costs going up and prices staying flat, how in the world do you protect your profit? Well, they've developed this really smart two-part defense strategy, and it's all about working smarter, not just trying to get bigger.
Part 1 is all about geographic focus. Instead of trying to ship all over the world, the big strategy for 2026 is to consolidate and really deepen their presence in the Americas. Why? It's simple, really. Shorter transit times mean less risk of something going wrong with shipping and, of course, lower freight costs. They're basically cashing in on relationships they've already built in markets from Colombia all the way up to Canada.
Strategy number 1 is all about geographic focus. Instead of trying to be everywhere at once, they're doubling down on the Americas. This is smart. It shortens transit times, it cuts down their exposure to that crazy long-haul shipping volatility, and it lets them build deeper, stronger relationships with key retailers from Colombia all the way up to Canada.
Now, the second part of their defense is all about branding, and this slide shows the difference perfectly. On one hand, you've got the old way, the commodity trap, where your fruit is just, well, fruit. It's like everyone else's, and you're forced into these brutal price wars. But on the other hand, you have the Candela strategy, where you create your own brand to claim a premium spot on the shelf and build real loyalty with buyers.
And strategy number 2 is something they call the brand defense. I love this. It's a very deliberate pivot away from just selling a generic commodity, which almost always ends in a race to the bottom price war. Instead, they're building their own premium brand, Candela, to carve out a spot in the market that's based on quality and loyalty, not just who's cheapest.
And here it is out in the real world, the Candela Fresh Mandarins brand. It's so much more than just a logo on a box, you know? It's a promise of quality that lets them stand out from all the generic, unbranded competition.
And let me tell you, this isn't just a plan on a PowerPoint slide. It is happening right now. The Candela brand is already getting real traction in North America, letting them sell their product as something special, a step above the generic competition. This is how you defend your margins, by creating value that goes beyond just the fruit in the box.
And guess what? It's already working. The general manager, Christian Gamarra, says their brand has already gained a real foothold in key markets like Canada, the US, and Mexico. And in some cases, it's putting them ahead of the generic brands. That right there is the power of a brand in action.
So, let's put all the pieces together. How do you actually solve this profitability equation for 2026? It's clear you have to evolve. You have to become something more than just a high-volume exporter.
And this is it. This is their formula for success. You start with those technical alliances to boost your yield and your quality. Then, you add that powerful Candela branding to lock in a premium position in the market. That 1-2 punch is strong enough to absorb the logistic shocks that you know are coming and still deliver premium profitability. That is the winning equation.
So this brings us all the way back to our equation, and it really sums up their entire strategy. You take the expanded volume from technical alliances, you add the premium positioning from the Candela brand, and that combination helps you absorb the shocks from logistics and still come out with premium profitability. It's a total evolution from being a simple fruit exporter to becoming a true branded supplier. Okay, so the Americas are the big focus for 2026. But how does this strategy set them up for the future? What's the long-term vision here?
But the story doesn't end here, not by a long shot. While the immediate focus is on the Americas, the long-term vision is definitely global. The next frontier is unlocking those lucrative, but very heavily regulated markets in Europe and Asia, and that's going to require them to pursue even tougher international certifications.
The company is already working hard to get the really tough international certifications they need to enter these super lucrative, but also super regulated markets in Europe and Asia. That right there is the key to their long-term sustainable growth well beyond 2026.
So, it all brings us to this one final big question. In a world where global supply chains are getting more expensive and more chaotic by the day, is this kind of smart branding, turning a simple fruit into a premium product, the only real path to survival for farmers and producers everywhere? It's definitely something to think about.
And that leaves us with one final big thought to chew on. In a world with rising costs and tangled supply chains, you have to ask, for a company like this, is the power of their brand actually becoming more valuable than the physical fruit they're shipping? It's a huge question, and the answer could really define the future of the global food trade. This is the brief on Peru's 2026 Mandarin export strategy. Agribusinesses Gamafruit and Agro Gamarra are scaling up exports this year, giving us a perfect case study on balancing aggressive agricultural growth with fierce global supply chain headwinds. This isn't just a farming story, it's a high-stakes logistics and branding chess match. First, the growth engine. They're targeting 170 export containers by combining their 40 hectares in Huaral, Peru, with third-party technical alliances. Plus, they're adding new varieties like Satsuma and Primosole. It's kind of like building a diversified investment portfolio. It spreads out the harvest windows to project against sudden market drops. But growing more fruit is only half the battle. Actually, getting that increased volume across the ocean exposes them to severe global headwinds. Second, we've got to evaluate the international market risks. Global fuel supply shocks are skyrocketing fertilizer costs right alongside massive maritime rate hikes and shipping space shortages. So if fuel and freight costs are eating the margins, how does a producer avoid bleeding cash on every container shipped? Well, the answer to surviving that logistical margin squeeze isn't just cutting costs. It's changing how the fruit is perceived and where it's sold. Finally, the brand defense. Instead of selling a generic commodity, they're aggressively pushing their proprietary Candela Fresh Mandarins label. Geographically, they're hyper-focusing on the Americas, the US, Canada, Mexico, and Colombia to shorten transit times, saving Europe and Asia for later. You see, branding a piece of fruit isn't just marketing. It's a literal financial defense mechanism against rising freight costs. By evolving from a simple volume exporter to a premium, regionally focused brand, these producers prove that strategic positioning is the ultimate shield against global market volatility.